If you think you're going to follow the concepts of FIRE, retire early, and then live happily ever after, be careful. You could be in for some nasty surprises. Hi, my name is Yogi, and in this video, I'm going to be challenging some of the concepts of FIRE, the concepts that have either been addressed incorrectly, in my view, or have not been addressed at all. And I'm going to be doing that from this gorgeous Franz Josef Glacier here in New Zealand. Unfortunately, it's all shrouded in clouds at the moment. I hope that during the video, the clouds move and you get a glimpse of the glacier behind me. Anyways, let's get back to the topic. So the first one and the obvious one is the 4% rule, on which majority of the FIRE concepts are based on. In simple terms, 4% rule is that you withdraw 4% of your total net worth every year and you will not run out of money. To simply explain, let's say you have a total net worth of $1 million. It could be dollars, rupees, euros, doesn't matter. But let's say it's $1 million, and then you withdraw 4% for your expenses. Then come the markets go up or down, you adjust it to inflation, and conceptually you will not run out of money. This is called the safe withdrawal rate. Unfortunately, it's not as safe as it seems, and there are multiple reasons. Reason number one is that majority of the studies for 4% rule have been based for the US market, and it's been back tested for the US market. So if your investments are outside the US or in different countries or in different currencies, then be careful. The second is that it is assuming a portfolio of 70% stocks or equity and 30% debt. Now again, most likely your portfolio would have equity, debt, real estate, gold, cryptos. So the mix would be much more different than, let's say, just that 70-30 or even 60-40 on which these researches or the studies are based on. And the third and the most important reason is the studies show that you will not run out of money for a period of 30 years. Now this works well if you're retiring at a traditional age of maybe 60 or 65 with a lifespan of, let's say, 90 years plus minus. But if you're planning to retire early at the age of 50 or even 40 or even earlier than that, that means that you're looking for a retirement span of 40 or a 50-year period, for which this puts you in a lot more risky category with a 4% withdrawal rate. Now, what can you do to prevent this risk? The first is that you look at your total portfolio and do your research for the markets in which your portfolio is spread out, that what has been the studies saying in those particular markets. Most likely you will see the studies showing a withdrawal rate of between 2 to 4%. My suggestion is that whatever the studies show for those particular markets, go a bit safer and adjust that by 0.25% or even 0.5%. So if the market says 3.5% is the safe withdrawal for that particular market, then I would say that go for 3.25 or 3%. This is your future life, so you want to go even safe than sorry there. So that's the most important thing that you can do. I've made a dedicated video on 4% with a lot more details on what you can do and what it is all about. So do watch that and you'll get a lot more details on that. The second one, which is not talked about or not addressed in the FIRE concepts, is the sequence of returns. So if the withdrawal rate helps you determine if you are ready to retire early, the sequence of returns can help you determine when you can retire early. Simply put, sequence of returns is in the sequence in which you get the returns. So let me explain with an example. Let's take, to illustrate, let's take two people, Jack and Jill, let's say, where both Jack and Jill have the same amount of net worth that they are chasing. So let's say $1 million. They are looking for a same withdrawal rate. Let's put 3%. And every year they are going to use that 3% withdrawal rate during their retirement and withdraw based on that out of that million portfolio, and then adjust it from the year one itself on the inflation in the market that they are, let's say 5%. So $1 million withdrawal, total net worth, a 3% withdrawal with a 5% inflation. So these are the, let's say, the assumptions to keep both the cases same. Now let's take Jack's case, where Jack retires, and in the year one of retirement, the market goes down by 25%. Year two of the retirement, again, because of the market circumstances, it again goes down by 25%. And year three of the retirement, let's say the market stabilizes and it is 0% returns for that year. And year four, the market picks up. It goes up by 25%. And year five, again, the market picks up by 25%. Now, let's take Jill's case. Now, when Jill retires, let's assume the other way and let's flip those returns, that in year one of retirement for Jill, it is 25%, the market goes up. The next year, again, the market goes up by 25%. In year three, in Jill's case, the market, let's say, stabilizes, it flattens, and it is 0% returns. And year four, the market goes down by 25%. And year five, the market again goes down by 25%. So the withdrawal rate is the same, the net worth is the same, the inflation is the same. All the difference is the sequence in which both are getting the returns. Now let's compare the maths. And what you will see from the maths is that there is almost 100K difference in both their cases. Now I hope that the markets do not do such 25, 25, 0, 25, 25 as I mentioned. But if you expand it over a 20, 30 year, 40 year period, because this is just a 5-year illustration, you will see it can have a big impact on the way a person may run out of money or even have much more money than what they started with. Now, typically, you cannot prevent a sequence of returns because it is due to external factors, which is the market. What you could do is definitely minimize the impact. And how you do that? First is have a very sound and a good bucket strategy. Bucket strategy meaning that you have for the first 2 years of your retirement investments in assets that are not linked to the market, so fixed deposits, cash, etc. So that you're not dependent on the market going up and down, at least on a short-term basis. The second is that you have a certain stream of passive income. Conceptually, let's say that your passive income is more than your annual expenses. On that basis, conceptually, you will never run out of money, or you will never touch the portfolio itself, because you're just going to sustain from your passive income. In reality, you will have a mix where you will withdraw not just from your passive income, but from your portfolio. So this building a passive income is a very important aspect to at least minimizing the sequence of returns. The third is, when you are ready to retire, you should look at the markets, how they have been in the last few years. So if you are, let's say, been in the bull markets, that for the last 2-3 years, the markets have just been steadily going up, the chances of the market going down increases. On the flip side, if the consistently markets have been down for a few years, the chances of the market going up are higher. So as you can imagine, When the markets are up for the last few years, it may give you a false sense of security that, look, you've got a good portfolio, your numbers stack up, but you may be entering into a situation where the sequence of returns go down. From a timing perspective, it's always better that your numbers work when the markets have been down. That means if the market go up, it can only get better for you. Now, on the bucket strategy itself, I would suggest watch my video where I address the 3 bucket strategy, how it can help you, what these buckets are, and this will definitely help you to become more resilient towards the sequence of it. The third point, which is implied in the FIRE concepts but not addressed enough, is taxation. Now, it is implied that your withdrawal that you make from your total portfolio on a annual and a monthly basis, it includes taxes. So let's again take that the $1 million case in Jack and Jill. So if they are withdrawing 3%, so that's 30,000, that should include their taxes, because if this is just their expenses, then they will have to withdraw much more, or so increase their withdrawal rate percentage, or have a bigger portfolio to have that net withdrawal of that 3%, that is. So for a 30,000 withdrawal with taxes or net expenses of 30,000, you will need to think about a gross withdrawal of anywhere between 40 to 60,000 depending on the country that you are living in. Because the taxes could be in different forms. It could be income taxes on your passive income, your dividends, rentals, your interests. It could be capital gains on whenever you withdraw from a portfolio. It could be even wealth tax from based on the country that you're living in. And it could be the overall taxes can range from anywhere between 10 to 52%, depending on some of the, at least in European countries where the taxes are very high. And keep in mind that the benefits that you may get for, let's say, tax concessions, if you're planning to retire early, that's way far off, where you will be getting those benefits probably in 60s or mid 60s, in certain countries, even late 60s. So you have a long period of paying those taxes. So be very careful that you're not just calculating your total expenses as your withdrawal rate, but you're also countering or calculating your taxes. To minimize that, first is work out with a chartered accountant or a tax advisor and see what could be the tax impact for you on your capital gains, on your income, passive income, currently and in future. The second is have a location strategy for your retirement if you have that flexibility. I've done another video about the link between citizenship, residency, and taxation, and how you can use that to your advantage to accelerate your FIRE journey. So do watch that and you'll get a lot more details there. The fourth point is addressed sometimes in the FIRE concept, but again, not that explicit as it should be. And that is considering your primary house outside the total FIRE portfolio. So simply put, your total FIRE target that you're chasing, you cannot or should not include the value of your house that you're living in. Now, there are multiple reasons for that. But the primary reason is that during your retirement years, you can't just withdraw parts of your house. While on the total portfolio, you can withdraw your stock, your debt, funds, or all kinds of assets. And the other important thing is that the strategy that you have for your primary house could have a big impact towards your journey to financial independence. I have many friends and many colleagues and many people I know who are what I call asset rich and cash poor. And that means that they have this big asset of a beautiful house that they are living in, but other than that investment, they have very little. Now, there is nothing wrong with living in a big house and a beautiful house, but what it does is it adds a lot more expenses. And the second is it doesn't add your journey to financial independence. So to avoid that, as an action, what you should do is relook at your strategy of your current house or your potential house that you're planning to buy. So in case for me and Seema, one of the reasons that we were able to accelerate our FIRE journey was that we stayed away from buying a big house. We almost did that once, and by not doing it, it provided us flexibility to travel to another country and work in another country. It provided us the flexibility of investing in assets that started producing money rather than us paying utilities and mortgage and interest for an expensive house. So have a look at that and see that how you can use that to balance with your living, but also your journey to financial independence. The last point is FIRE becomes so much about chasing a number, a target, that one, you don't, or many people are not enjoying the journey because you're just chasing a number, you're just saving, you're investing. And the second is that you're not spending enough time to at least plan what you're going to retire to. I have had lots of people reaching to us via the channel, via the different social media, and telling us that they're saying, hey, I feel guilty spending money. How do I balance it? Or they are saying, hey, I'm not enjoying the FIRE journey anymore because it's becoming too much a chase. So that is the thing that you'll have to be very careful about, that you are not just chasing a number. And how you can do that is, one, set a target for yourself every year that this is my saving number. Anything above that, I'm going to reward myself, upgrade my lifestyle to a certain extent and enjoy. The second thing, what you have to do is, even if you're in your 20s, 30s, 40s, start embracing hobbies, passions that you can retire to. Because if you do not do that, you will fall into what I call the one more year syndrome. And I have many friends I know that financially they are more than independent, but they are very insecure to take that bold step of retiring early. And they keep telling us that, hey, we are so much respect for you that you guys took that bold step. But they are not able to do that, and they are chasing this one more year of working because they have very little things that they have planned to retire to. So make sure that A, you're enjoying the journey, and B, that you're starting to develop hobbies and passions that you can retire to in future. So in summary of these points, for 4% rule, do your research and define your number that works for you, that works for the market based on the research that you've done. For the sequence of returns, have a very good bucket strategy that will help you to become more resilient against the sequence of returns. For taxation, understand the different taxes that may be applied or implied to you during your financial independence journey as well as during your retirement early journey, and start thinking that what could be your location strategy, what could be your residency strategy for long term. For your house, what you need to do is make sure that you are balancing your life, living, family, but also balancing it with the journey to financial independence. And the last is that enjoy the journey to financial independence and have a plan to retire to something. So I hope this helps you quell some myths, as well as let's say get a better clarity of some of the FIRE concepts. And I hope this was useful. And if you did find useful, please do like and subscribe the video. Until the next location, until the next video, goodbye from me. Bye-bye.